You may not realize it yet, but something just happened, something massive, that directly threatens not only the value of the dollars in your pocket, but the future of the entire United States economy. And the scary part, it all starts thousands of miles away in Japan. Here is the reality we are facing. The largest foreign holder of United States debt is facing a total bond market meltdown. We are seeing 20 and 30-year yields in Japan hitting record highs. That is a sure sign that something fundamental is snapping in the global financial system. But let me be crystal clear. This is not just a Japan problem. This is a flashing red warning signal for you, for me, and for everyone living in America. Because what happens there is going to impact the United States dollar, the stock market, and your retirement. If you care about your financial future, you need to understand why the Japanese bond market is the first domino in a chain reaction that could reset our entire economy. Stay with me, because today we are breaking down exactly how this impacts your wallet. To understand the gravity of this situation, we have to look at the numbers. Japan is currently the most indebted major economy on Earth. We are talking about a debt to gross domestic product ratio of roughly 250%. Let that sink in for a moment. That means their government owes 2.5 times the total value of everything their country produces in a single year. For context, here in the United States, our debt to GDP ratio is around 120%, which is already appalling. But Japan, they are truly in a league of their own. Like all governments, including ours, Japan funds this mountain of debt by issuing bonds, whilst these bonds attract investors by offering a yield, an interest rate of return. But Japan has been unique. For years, they have carried this massive debt burden while artificially keeping yields at near zero. How is that even possible? It was only possible because the largest buyer of Japan's debt was its own central bank, the Bank of Japan. They did not care about yields, they just kept buying to keep the system afloat. But last week, something changed that rattled traders globally. Japan's leadership signaled that they were gearing up for a massive stimulus package. This is happening at a time when inflation is already rising, and their currency, the yen, is already weak. This shift has made the financial situation in Japan look incredibly precarious, and the markets are starting to panic. So, why is this a crisis right now? To fund all that extra spending for the stimulus, Japan is going to have to unleash a new wave of long-term bonds. It is basic supply and demand. As more supply of bonds hits the market, investors are going to demand a higher yield. They want to be compensated more to carry that additional risk. This speculation is exactly what is driving these record high yields we are seeing right now. In fact, traders have literally dubbed this the tech high trade. It is a massive bet that yields will continue to rise even above the level they are at today as more bonds are issued and the debt situation gets messier. This leaves the Bank of Japan completely trapped. Think about their position. If they print more yen to buy their own bonds and cap those yields, they risk crashing their currency. But if they step back and let yields continue to rise, well, when you have a 250% debt to GDP ratio, even a small rise in yields, the cost to borrow money, is going to tip the nation into a state of crisis. No central bank, no nation, and no currency has ever survived this level of debt for long without facing one of two outcomes: an outright default or hyperinflation. And you might be asking, okay, that sounds bad for them, but why does this matter to me in America? Here's the direct impact. Japan is the largest foreign holder of United States treasuries. They are sitting on about $1.2 trillion of our debt. Over the last 9 months, they kept buying our debt even while other nations were ditching the dollar. They were willing to do that because Japanese bonds paid practically nothing. But that is changing. As yields rise in Japan, the math no longer makes sense for Japanese investors to buy American debt. We are about to see a massive shift. You are going to see insurers, pensions, and Japanese banks all repatriating their money, bringing their funds back home to Japan. Okay? As you see this flood of capital leaving the United States Treasury market, it is going to have a direct impact on the financing costs of United States debt. And this is happening at a time when the United States really cannot afford less demand for our bonds. Okay. As it stands today, the interest alone on United States debt is over $1 trillion a year. To put that into perspective, that is more than the United States pays on its entire defense budget annually. But it does not stop there. This situation threatens to unwind one of the largest invisible global financial trades in history, the yen carry trade. Yeah. Let me explain this simply because it is crucial. The yen carry trade is basically an interest arbitrage play. Investors borrow money cheaply in yen, thanks to those near zero interest rates, historically, and then they invest that money abroad in something that pays more. They put it into United States treasuries, corporate bonds, real estate, crypto, and the United States stock market. Okay? It is a great trade as long as two things happen. Number one, rates remain near zero in Japan, and number two, the yen remains weak. But if either of those things starts to change, like yields start rising right now, suddenly the whole thing starts to crack. These are highly leveraged positions. If the cost of borrowing yen gets too high, the math stops working. Suddenly, you have a violent sell-off. Traders have to unwind these positions all at once. This is why you could see a market meltdown that seemingly comes out of nowhere. We are not talking about some niche strategy or a small investment club. When you step back and look globally at the amount of money tied to the yen carry trade, including derivatives, we could be looking at tens of trillions of dollars in global finance all connected to this one trade. You know, when this starts to blow up, it does not stay contained in Japan. It ripples through the global economy, hitting the United States bond market, the stock market, and yes, your retirement account. You know, we actually got a taste of just how quickly this can happen. Think back to August of last year. In 2024, the yen started to strengthen. That is that second component that has to stay in place for the trade to work. Almost immediately, the ripple effect was felt right here in the United States. As positions were unwound, tech stocks suffered. Wall Street was whispering that it might be a Black Monday. No one knew what was going on at first because, again, it seemingly came out of nowhere. No one was prepared. Now, after a few days, things settled down. But that was a warning shot. It was a reminder of just how quickly things can change. We got lucky last time. Next time we might not be so lucky, especially because this time the changes coming are structural. When this impacts the United States dollar, it impacts us all. Higher rates on United States treasuries mean higher rates on everything else. We are talking about higher rates for mortgages, credit cards, business loans, and car loans. You name it, it is going to be impacted when the government is spending more on interest to service the debt. It leaves less funding room for programs like Social Security, things that fixed income retirees depend on, and even if they create funding for those programs, they are going to have to fire up the printing press to do it. Okay? This means the value of each and every dollar you have in your savings account, in your retirement, and in your checking account is going to be reduced. They are going to devalue the dollars you already have. Nominally, the price of your house or stocks might stay the same or even go up, but the real value, what that money can actually buy, is going to drop. Okay. This is an acceleration of the currency reset that is already underway. We know nations are intentionally moving away from the dollar, but now we have an unintentional move away from the dollar. Our largest foreign buyer might be forced to abandon United States assets. So, how do you protect yourself? Many people believe they are diversified. They think, I have stocks here, bonds there, maybe some real estate. But if you have studied currency resets, you understand that everything tied to the dollar-denominated assets suffers during a reset. Historically, we see this time and time again. Even real estate can become highly illiquid or worth significantly less in real terms. Okay? This is something we have studied deeply here at ITM Trading. If you want to learn more about how different assets perform during currency resets, we have a completely free resource for you called the Built to Endure Report. It is packed with 100 years of data. You can download your copy by scanning the QR code on the screen or clicking the link in the description. Ultimately, history tells us there is one asset that truly protects your wealth on the other side of this reset, an asset that increases in purchasing power while the dollar loses value. That asset is real, physical, tangible gold. Thank you so much for watching. If you enjoyed the video, please take a moment to like, comment, and subscribe. Your support truly means a lot and helps this channel reach even more people. I'll see you in the next one.